Holy shit. Oh man. Folks, am I live? Am I live? Oh my fucking god. This is the problem. It's been so long. It's been so effing long. I've done a live stream that I completely forgot to hit the live button. I have been talking to myself for the last 20 minutes. It's 6:30 now. I was live at 6:15. Yeah, I've been talking to myself for the last 14 minutes. I literally went through so many things. This is so frustrating. I went through so many things. I went through the entire presentation. I asked you guys so many questions, and no surprise, nobody was answering. Nobody was answering those questions because I was like, wow, today the chat room is really, really quiet. There's no engagement because I was asking all these questions and I wasn't getting any responses because I wasn't live. Guys, I'm so sorry. I'm finally here. Hopefully the audio and the video is working well. So let me know in the live chat if everything is working well, the audio and the video. Just want to make sure that there are no technical difficulties. Oh man, this is so effed up. It's crazy. Anyway, so thank you so much for joining, everyone. Shout out to Anthony, Renee, Tessa John, Richard John, Renee again, Ken Casper. We got Nikki, Claudio, Alberto, Stefan, Nicholas, everyone, thank you so much for joining. I do apologize because I was live for the last 15 minutes. I just did not hit the live button. And no surprise, I wasn't getting a lot of responses from you guys. And it was just me talking for the last 15 minutes. Anyway, so thank you so much for joining. Today is inflation day. Bright and early, in less than 30 minutes, we're going to get the CPI numbers for the United States. Inflation number is very, very important. That's really what's going to dictate interest rate policy from the Federal Reserve. FOMC is going to essentially take the inflation data and they're going to project out what the inflation numbers and what, of course, the interest rates are going to look like. So thank you so much for joining. I really appreciate you all. It's been a long time since we've done one of these live streams. So for that reason, that's probably one of the reasons why it took me some time to kind of refigure that out. So, but yeah, do definitely participate in the poll as well, because right now we've got over 100 votes. I want to get this number to at least 500 in the next 30 minutes. I want to get a lot of data and a lot of expectations from you. So definitely do vote. This live stream for the next 2 hours is for all of you guys. Stocks, fundamentals, technicals, macros, recession expectations, inflation, interest rates. We are going to cover it all. Okay, so in the next 30 minutes, CPI numbers come out. We're going to break those down. We'll talk a little bit about the market's expectations. I've got lots of really, really interesting information to share. In this live stream, we got some expectations from Goldman Sachs, from JP Morgan, from the actual consensus from all these other institutions. We're going to break all that down. And of course, traders and investors are waiting worldwide, just patiently at the bench, waiting for those inflation numbers. So once again, thank you so much for joining. It's been a long time. It's so good to hear and see all of you once again. So again, thank you so much for being a part of our morning inflation live stream. So this right here is Goldman Sachs. By the way, let's just run through the expectations first, and then we'll circle back to some of the institutions and some Wall Street banks and what they're expecting from inflation. But month over month, the consensus is 0.0%, so no change expected. Year over year, 3.1%. So that again is headline inflation. And core inflation is at 0.3%, with year over year expected at 4%. So month over month for core, which is excluding for the more volatile food and energy, at 0.3%, and year over year at 4% as well. So those are going to be the core expectations, core inflation expectations. And really, when it comes down to the Federal Reserve, they focus on core inflation more, right? Core inflation is really what matters for the Federal Reserve. It's not headline, it's not anything else with respect to any specific prices, but it's really core inflation, more specifically core PCE, the personal consumption expenditures, is what the Federal Reserve is really focused on in bringing down to 2%, sub 2%, to get down to their target. This right here is going to be inflation nowcasting. And for November, the expectations are for headline CPI month over month to have not changed at all, negative 0.01%, core to be up 0.33%, PCE to be also flat at 0.08%, and core PCE to be up 0.28% on a month-over-month basis, and year-over-year, it's expected at over 3%, headline CPI, and core expected at just a little bit over 4 as well. And then finally, we've got 2.86% for PCE and core PCE at 3.46%. All these numbers are still above the Fed's target, but there's a big but here. What I want to mention is that this is simply the rate of inflation which is slowing down, something that we have discussed in our previous videos, and that is to say that yes, from back in June of 2022, when it was at 9.1%, we have come down to 3.2, which is great, but that doesn't mean that prices are going down. It's a huge difference. This is simply telling us the rate of increase on a year-over-year basis that has slowed down from 9.1 to 3.2%. This does not mean that inflation is down 50% or 60% or 40%. It simply means the rate of increase in prices has gone down on a year-over-year basis from 9.1 to 3.2%. That is all that means, because overall inflation, if you take a look at prices in general, are still up. This right here is the chart that represents that, and you can see that since 1915, right, so almost 100 years ago, prices were significantly lower. The CPI price index was at closer to 10.1, and it's now sitting at well over 307. So prices in general have increased. It's just the rate of increase that has now slowed down significantly. So Luis, thank you so much for the donation. And again, if you have any specific stocks, I would really appreciate you guys donating if you want to kind of get a full detailed analysis. I'm happy to go over the fundamentals and technicals for specific companies. So Luis, just give me a couple minutes and I will come back to VC. We'll do an analysis on that stock here. Manos, Caddy, yesterday I've realized the NASDAQ S&P 500 ratio is 3.15 as it was in the bubble of 2000. So Manos, could you elaborate a little bit? What ratio are you looking at? The NASDAQ to S&P 500, is that the index levels? Because yes, I mean, if you take a look at the NASDAQ, it's at 14,400. S&P is at 4,600. So if you do the math, 14,400 divided by 4,600, yes, that's at 3.13. So I'm assuming that's the ratio that you are mentioning in your comment. But it's really just the increase in overall growth and, of course, prices that we have seen for this ratio. But that's actually quite an interesting way to look at the market sort of valuations. But I don't know how much weight it actually has. I mean, clearly the NASDAQ's outperformed the S&P over the last 10, 20 years, considering that NASDAQ's, has growth and tech as a bigger contribution to the overall S&P 500, which has over 500 companies, and it's very market cap weighted. So is the NASDAQ, but NASDAQ definitely has more weighting to those tech and growth companies. So, but I'll come back to that. I think that's a very simple and interesting way to look at overall market valuations. But first, I want to go over to those meeting probabilities as well. So tomorrow, we've got the Fed meeting. So FOMC meeting starts today. But tomorrow is the release of the policy statement and also the SEP, that's a summary of economic projections, and interest rate expectations as well. And now the market's pricing in for a pause. Again, a 98% probability the Federal Reserve is not going to do anything tomorrow and keep rates steady until March of next year. And then five rate cuts priced in all the way through December 2024. So in a year's time, market's expecting rates to be down to 4.25%. Now, the market does carry a lot of repricing risk, as we have already discussed, because the market's pricing in 5 rate cuts, and the Federal Reserve, how many rate cuts has the Federal Reserve told us? How many rate cuts has the Federal Reserve mentioned in their summary of economic projections? I want these live streams to be engaging, okay? I want you guys to engage, comment, chat, discuss, and there's going to be a lot of questions, and I'm going to see who's been doing their homework. So in their summary of economic projections, how many interest rate cuts is the Federal Reserve penciled in? What have they put into their summary of economic projections? How many? What's the number? I want to hear from all of you in the live chat. Definitely do comment and also do vote for inflation expectations, the poll that we have going on right now, whether you believe inflation is going to be above, below, or at consensus in less than 30 minutes when CPI numbers actually do come out. So let me know in the live chat. Peter says 2. How many people agree? How many people believe that it is 2? How many people believe that it's actually more, 3, 4, or it's less? 1. Carlos says 2. So I want to hear from more and more people. How many interest rate cuts is the Federal Reserve pricing in or penciling in to their summary of economic projections? So Mark says 2. Dev says 2. Sai Kamal says 2 rate cuts. I'll give it a couple more minutes. I want to see. So Kevin says 5. But this right here is market's expectation, right? And that's why the market does carry a bit of a repricing risk, because Like I said, market's pricing in 5, and the Federal Reserve has expected or penciled in, and the answer is 2. So you guys were absolutely right. A lot of you were correct. It's 2 rate cuts is what the Federal Reserve's penciled in to their summary of economic projections. Now that will be subject to change, most likely tomorrow when we get that report, the summary of economic projections, and I will be live to cover that as well. So yes, it is indeed 2. Now, the Federal Reserve, on the other hand, has also penciled in 1 more rate hike for 2023, and the market's not buying that bluff. Market's thinking that Jerome Powell's been hawkish. He's not going to raise rates anymore. We are done with rate hikes, and 98% probability that we're going to pause. But of course, the Federal Reserve still penciled in 1 more rate hike, which it's possible that they don't actually end up doing that. And the market's pretty much priced in a pause. It would be a huge surprise if the Federal Reserve ends up hiking tomorrow. It would be a huge surprise. And again, less than 2 days, in other words, tomorrow is when the meeting is and the press conference and the summary of economic projections and the statement will be released. So let's go over to some expectations from Goldman Sachs, okay? So if core month over month comes in less than 0.2%, then the S&P's reaction is expected at 0.8% or higher. If it comes in at 0.2 and 0.3%, S&P is expected to be up 50 basis points, 30 to 40 basis point increase month over month. S&P could be down, up or down 30 basis points. And if it's over 0.5% in core inflation, S&P could actually be down over 1%. Now, the problem with these type of predictions is that they are quite irrelevant and useless to begin with. And the reason for that is because we could know, we could possibly know what the inflation numbers might end up looking like. In other words, what print we're going to get in less than 30 minutes and still not know how the markets might react. That's the beauty of the market is we could gauge whether the market's going to be higher or lower, but we still might not know by how much. Is it going to be up 50 basis points, 1%, 1.2, down 30 basis points? We're still not going to know, considering that there's so many variables at play. This right here is from JP Morgan. They're putting in a 2.5% probability on headline month over month printing at 0.4% or higher, which obviously would be a very, very hot print, meaning that it would be brutal, right? It would be pretty bad. 0.4% or higher would not be great, and it would not be well received by the market. And that's why they're expecting the S&P to be down 1.5 to 2%. If it's between 0.2 and 0.3%, this is headline month over month, which is a 25% probability according to JP Morgan. S&P could be down 50 basis points to as much as 1%. And if it prints in line with consensus, which is 0 to 0.1%, S&P could be up 25 to 50 basis points, a very, very muted reaction. And the bond market could also have a very neutral reaction to this print. Now, they also have a 22.5% probability for deflation, which is actually quite surprising in my opinion. They've got a very high probability that inflation actually comes in below expectations, and we come in with a little bit of deflation at 0.1 to 0.2%, and that will certainly be very bullish for the market, and the S&P could add 75 basis points to as much as 1.25%, and they've got a 5% probability that inflation month over month decreases by 0.2% or more, and in that scenario, obviously, it's going to be very bullish. I mean, the markets will absolutely rip higher, and they expect S&P to add 1.5 to 2.5%. Now, these right here are all the expectations from all Wall Street banks, which I'm going to break down very, very quickly, and then we're going to jump into the markets, take a look at how the NASDAQ and the S&P is doing. But we've got Scotiabank here expecting year over year at 3.1, core expected to be 4%, CIBC 3.2, 3.9. We got SEB 3 and 4. We got SocGen at 3 and 3.9. We got Goldman Sachs at 4% for core. Morgan Stanley 4% for core. TD Securities 4% for core. Barclays at 4%. Citi 4%. Pretty much everyone's at 4% except for B of A. So Bank of America expecting 4.1 on a year-over-year basis. This is core inflation, by the way, and UBS at 4.1% on a year-over-year basis as well, kind of in line with B of A. So there's only 2 banks that are expecting 4.1, which would be a little bit higher than the previous number. So previous number, of course, was 4%. If you accelerate to 4.1, that's going to be bearish, in my opinion, for the market. But everybody else, HSBC, JP Morgan, UNI Credit, we got Barclays, Citi, RBC, UNI Credit, TD Securities, Morgan Stanley, they're all expecting 4% to be that core inflation number. So we'll take a look at, of course, what the numbers end up looking like in about 17 minutes. So very quick analysis on VC. That's going to be Vestion Corporation. for Luis. Market cap's about 3.4 billion. Couple things I want to point out. The volume is actually quite low, 344,000 shares. So it's not like a heavily traded stock. And on an annual basis, seems like the revenue's been pretty stagnant with slight increase in 2022. Profitable company, global technology company which engages in design, engineering, and manufacturing of electronic products, automotive vehicles, and supplies automotive parts. No wonder the margins are actually quite low for the business, only 3.3% profit margins, no dividend yield, and on a technical basis, it's certainly down from its recent highs, 28-29%. It's been actually quite volatile. It's not really giving us a very sort of clean follow through, and we have seen a lot of volatility for the stock. As you can see, week after week, it's going up, down, sideways. It's been a lot of consolidation, but support level is going to stay put at $92, $93, and resistance all the way up to here at 169. So it definitely does have a pretty wide range of about 70 to 85% within which it's been trading. So support level is going to stay put down to $92, $93 for VC. And from a valuation perspective, very quickly, 22 times earnings, a little over 10 times cash flow, under 1 time sales. So it's not super expensive. It's quite reasonable, but I'm assuming the growth expectations are also actually quite good. From 550, they're expected to go up to $12.87. So that's actually a very, very strong growth rate for VC. Okay, folks, definitely do vote on our poll. 174 votes right now. We've got over 250 people watching. Definitely do drop a like on this live stream. I would really appreciate that so it gets pushed out to more and more people. Let's see if we can at least get up to over 100 likes on this live stream. I would really appreciate that, and definitely do vote and participate on the poll and what you're expecting from the inflation numbers. Are we going to be above consensus, below consensus, or at consensus for inflation numbers? So this right here is the consensus, and make your predictions, place your bets before the CPI numbers come out in under 15 minutes. This right here was the previous month, October CPI, and energy is in full-blown deflation right now. So fuel, oil, electricity, even gasoline, it's been selling off a little bit over 15% on a year-over-year basis. And of course, everything else has been somewhat higher on a year-over-year basis, except for used cars and trucks, down 7.1%, medical care services down 2%, and we've also got energy overall that's down over 4.5%. Shelter prices, again, big wild card. It has been slowing down in the rate of increase. So if you come over to shelter here, you'll notice that we are seeing it slow down from 8.2%, now only up 6.7% on a year-over-year basis. So it is slowing down pretty well, but we are still nowhere near close to deflation. And that's actually, in my opinion, one of the reasons, one of the incentives for the Federal Reserve to start cutting rates. 2024, in my opinion, is actually going to be a very, very big year for the market, because it's going to be a very political year. Not only do we have the national elections in India, we've also got the presidential elections over in the US, and that collides and coincides with each other once every 20 years. So very, very big year, lots of policy changes, hopefully, and potentially, and of course, the market's going to react in certain ways. I'll do a specific video going over how the markets have performed when there's political years in the US, but then there's also elections in India. So we'll do like a comparison analysis on what that ends up looking like for the market. So, David, thank you so much. I appreciate it. What time is it over here? So it is about 6:45 p.m. So it's actually not bad at all. Much better than, well, actually, I would argue it's different. I mean, Dubai, it's like, of course, an hour and a half before India. Market opens here at 8 p.m. and Dubai opens at 6:30 p.m. But it also closes early in Dubai, which is a lot easier for me. Over here, the market closes at 2:30 or 3 in the morning. So that definitely can be somewhat frustrating sometimes. Stefan, I'm going to be doing a video on Walgreens very soon. So I know there's a lot of questions on Walgreens. We'll be taking a look at it in a more specific video. Can anyone tell when the CPI will be available? So it's going to come out at 8:30 a.m. Eastern. So in 12 minutes, we're going to get the CPI numbers. And of course, we'll take a look at the market's reaction and how we are doing. We're going to put together the S&P, the NASDAQ. Of course, the bond market's going to be part of the analysis as well, because it has certainly been selling off. S&P 500 over here right now is up 21 basis points. So this is where we are. We're going to take a look at the market's reaction, of course. And QQQs are up 34 basis points. I've got another video coming out that's going to go over the rebalancing of Magnificent 7 stocks because that's really one of the reasons why we saw a heat map like this where these 7 companies were down. The Magnificent 7, the core 7 were down significantly yesterday, and yet the market was up on the day. Does anybody want to take a guess? Take a guess on when was the last time the Magnificent 7 companies, these 7 stocks, the large cap tech 7 companies, Microsoft, Apple, Nvidia, Google, Meta, Amazon, and Tesla, when was the last time, what year these 7 stocks dropped and yet the NASDAQ was up on the day? When was the last time this happened? I'll wait for some of the guesses here, but what year did Magnificent 7 sold off on the day and the NASDAQ was up? When was the last time you witnessed this? It's actually quite crazy that it hasn't happened in such a long time. But let me know in the live chat what you think, what year. So Joel says 2016. Let's see. So Joel says 2016. 2008, Anthony says, oof, okay, those are some pretty good guesses. 2020, Renee. Come on, guys, come on. We've got over 300 people watching. I want to hear more engagement. I want to see more comments, more questions, more conversations, more discussions. Group price, I don't think it's ever happened, to be honest, till yesterday. Fair, because that is quite odd if you really think about it. The largest 7 companies, the tech, the big Magnificent 7 selling off and the NASDAQ was still up. That is quite unusual. But let me know what year you believe this happened before yesterday. Kevin says 2009, Sanjeev says 2008, 2001, 2008, 2020. So the answer is 2012. 2012 was the last time these Magnificent 7 stocks sold off and the NASDAQ was higher. And it's not happened in over 11 years. Just think about that for a second. In over 11 years, we've never witnessed these 7 stocks selling off while the NASDAQ pushing higher. Absolutely insane how much weight and how much concentration we've seen in these companies. All right, everyone, so 10 minutes to go. 10 minutes to go for inflation numbers. The bond market right now, so the 10-year yields are dropping back under 4.2%, so 1.28% decline here. We've got the QQQs up 33, we've got the SPY up 20, and the dollar index is also selling off a little bit over 40 basis points, with crude oil down over 1%, so back under 71 bucks a barrel. Volatility is muted, down about 40 basis points, a little bit under 12.6. And Bitcoin and Ether also pushing back higher after the sell-off that we've seen over the last couple days. Nuno, I did miss your predictions for CPI. So there's not really any predictions, but there are, again, some consensus general overview of what the CPI numbers are going to look like. My expectations are very simple. If it comes in hotter than what the expectations are, which I don't believe it's going to, considering that energy prices have been coming down. Energy prices are indeed lower. Shelter prices have been, I guess, a little bit up there, but the rate of increase has been slowing down. And of course, food prices have also slowed down a little bit in the rate of increase. It's possible that we come in with a little bit of a better print, which could lead to some market momentum on the day today. So again, it's very simple. If you come in above consensus, market's not going to like that very much because it's going to reiterate a possibility for a potential rate hike. It's going to drop those expectations for rate cuts, and the market's not going to like that very much. But if you come in below consensus or better than consensus, then that reiterates that soft landing scenario, and the markets could really see that as a big positive catalyst to push higher. All right, folks, you know what time it is. We're going to do a quick video. I want to hear from all of you. Where are you tuning in from? What part of the world are you joining us today for these inflation numbers? So definitely do comment in the live chat so I can give a shout out to each and every one of you. And thank you and appreciate you for joining in this morning for our inflation live stream. And I'll get back to all the questions here. Frank, good morning. Caddy, love to hear your thoughts on SWAV. Looking like a super cheap, underappreciated stock. I'll definitely take a look at that Frank will come back to it. Any thoughts on ASML, time to take profits, or is there more up catalyst? So Mark, I love ASML. I'm going to hold on to my position right now. I'm up, I think, over 12, 15%. We'll continue to hold on to that position at the moment. So comment, where are you guys joining in from? I would really appreciate that. Shout out to each and every one of you. So we got Warsaw, Poland, we got Texas, Portugal, Saudi Arabia, Maryland, Germany, Slovakia, Noida. That's interesting. That's amazing. My brother's joining me today. Greece, we got Puerto Rico, we got India, California, Malaysia, Dubai, Croatia, Los Angeles, Spain, Vancouver, UK, London, Singapore, San Diego, Netherlands, Canada. We got Phuket, Thailand, the UK, the US. Good morning from Boston. I love Boston. Always want to visit Boston. Athens, Greece. Tell me, Chris, what's the best time to visit Greece? I'm planning a trip next year. We got Canada, we got Denver, we got Singapore. Awesome, awesome. Thank you so much, everyone, for joining in. I really appreciate all of you. And it's actually quite interesting always that we take our time in the morning to jump on this live stream, look at the inflation data, look at the market expectations, market's reaction. Boba says, your neighbor, Gujarat. Wow, really? Gujarat is my birthplace. That is awesome. That is awesome. So yeah, coming back to Gurgaon, Yogesh says, that's awesome. Bihar, Dominican Republic, NYC, Montreal, Jakarta, New York, Chicago, Singapore, Dallas, Texas. Chris says September or spring. Perfect. I'll keep that in mind. So again, thank you so much for joining, you guys. And now we are less than 6 minutes away for the major inflation numbers over in the US. I'll do an audio check here very soon. So just so we are good with respect to the audio and the video. And then we should be all set with those inflation numbers. Tomorrow, FOMC, another live stream coming your way. And we're going to go over to the Federal Reserve's website and we'll take a look at the summary of economic projections, because this is really quite an interesting sort of environment in 2024, because I want to, okay, so what are the 4 reasons, 4 incentives I've highlighted why the Federal Reserve will cut rates? What are the 4 things I've mentioned in my videos the Federal Reserve would need to see so that they will be cutting rates? What are the 4 things? Let me know in the live chat. I want to hear what you, if you guys have been doing your homework, and of course, if you remember what the 4 things were, in other words, why the Federal Reserve would end up cutting rates. What are the incentives, so to speak, for the Federal Reserve to cut rates? David, yes, let's meet in Florida next year. I'm planning on being there sometime next year. We'll definitely meet up and we'll go out, have a nice dinner, lunch, drinks. Okay, Leonard says my prediction is 3.1% and 3.6% for AGP 0101. So Frank says recession, deflation, black swan, and politics. Yes, exactly correct. Those are the 4 reasons, 4 incentives for the Federal Reserve to cut rates, because the Federal Reserve does need something to fix. They need something to fix, otherwise they won't be changing policy. And those are the 4 things that are the most likely incentives for the Federal Reserve. I think the biggest one, which could be underappreciated going into 2024, is politics. I think it'll be a very political year, and of course the current, the current party that's in office will definitely would want interest rates to get cut as quickly as possible so that it helps support the borrowing, the spending, the saving. It kind of helps flourish the economy and gives less of a reason for the other party to come after the incumbents. So again, it's going to be a very political year. That could actually be one of the reasons why the Federal Reserve could end up cutting rates. But again, Jerome Powell has time and time again said that they are independent. They are independent of what fiscal policy or what political sort of party is in office. They don't want to focus on that. Their main goal is monetary policy, and they really want to serve the people, and they want to focus on creating good labor market and lower inflation. But you never know what's going on behind the curtains, right? You never know what's actually happening with respect to policy and what are the main reasons as to why they're doing certain things. So that I think is going to be quite interesting next year. Okay, so we got almost 300 votes. Come on, folks, we got 100 more left. We got 400 people watching. We're at 298 votes. We've got inflation numbers coming out in 2 minutes now. Let's see if we can get at least 100 votes before the numbers come out. 48% at consensus right now, with about 23% expecting above consensus and 29% below consensus at the moment. And we are going to now listen in to the live stream here. And then, of course, I'm going to bring this over here. We are ready to go.
CPI that's coming out in just 2 minutes' time. And we've been watching Treasury yields as well, which has been such a huge...
Is the audio good? Just let me know if the audio is good.
Yields have been driving every other market, and this morning the 10-year is yielding lower than it was yesterday. It's at 4.17. The 2-year is below 4.7% at 4.67. Rick Santelli is standing by at the CME in Chicago ahead of that data. And Rick, this is a pretty important number because of the Fed meeting, because we're at this inflection point where we don't know when they're going to start cutting rates.
This is it, folks. This is it. Just let me know if the audio is good.
There's good evidence of that. If you look at yesterday's auctions, for example, the $87 billion in 3s and 10s, the 3-year auction was very poor. The 10-year auction was definitely below average, just not as horrible as the 3-year. But yet, even though each of those auctions established a high yield for a week on the 10s and for the month on 3-year, right after the auctions, yields were moving down, and they were moving down before the auctions. There is a bias here that the Fed has done, that we're going to start getting rate cuts in early 2024, and that inflation is just something that not to worry about. Now, if any of those aren't true, and this number furthers the cause in one direction or another, it could have outsized consequences in the market. 410 is the big area to pay attention to in the 10-year. That's the big support area. It's been holding for the last several days. It was tested several times last week. Look for headline to be unchanged again because gas prices, of course, have been pushing down. And on the other hand, look for core prices to be a little bit more buoyant to the upside. One of the traps is that everyone is annualizing 3 and 6 month rates on inflation based on some of the better than expected current monthly numbers. You know, that could be a mug's game in the end because of the volatility and the notion that it's come down, but it's coming down too slowly and we're still not near 2%. And the numbers are out. It's 8:30 Eastern. Headline number is up 0.1%, which is a bit hotter than expected. We were looking for a second month reading of 0. Last month's reading of 0 was the best read since May of 2020 when it was down 0.1. Ex-food and energy up 0.3 as we discussed. That makes sense because of gasoline prices, of course, being down on the headline, but obviously not down enough. Up 0.3. In the rearview mirror, it was up 0.2. We had 2 0.3 in a row in August and September. Then in October, it moved down to 0.2. So the annualized rate is not going to move lower. The 3-month was 3.4. The 6-month was 3.2. They're not going to breach that 3% on these numbers. Now let's look at year over year. Year over year, 3.1, exactly as expected, 1/10 lighter than 3.2. The best we had was June of this year at 3.0. That was the best since March of 2021. And if you strip out food and energy, it's up 4%, exactly the same as our last read. And the last read and this read, well, they're the best since May of 2021 when it was 3.9. But that is a blessing. I'm sorry, 3.8. But it's a blessing in disguise, Becky, because we haven't been below 4%, that means, since May of 2021, and that is significant. Now, I'm going to throw something else out there that I normally don't throw out there, and that is, if you look at the CPI indexes, the raw indexes, in September at 307.78, that is the all-time high going back over 100 years. It's 307.05 right now. The core, which is seasonally adjusted raw data, is at an all-time high at 312.25. Never, ever been higher. The point here is that we annualize and we look at numbers at this point forward. But if you go back in the rearview mirror, inflation compounds, and it's that dynamic that the public is not very happy with.
So that's exactly what I mentioned in one of my videos, literally yesterday, right? This is what I talked about, and this was what I was talking about earlier today as well, that this is the index that overall prices are up in general, both on headline and core. It's not really going down. Prices are not going down. If somebody tells you prices are going down, they're not. They're going up. It's just the rate of increase is going down, and the rate of increase obviously coming in much better than what the expectations were. Actually in line with consensus for the most part, because we did see 3.1% increase in overall headline inflation and core coming in at 0 0.4%, actually 0.3%, which was in line with the consensus. And on a year-over-year basis, we're now sitting at 4%. So it's in line with the consensus. So if I reload this page, you'll notice that 0.0%, actually 0.1%, so slightly hotter than expectations on headline month over month. And of course, CPI year-over-year 3.1 in line with consensus, 0.3 in line with consensus, and 4% in line with consensus. So we got 3 hit on the consensus and 1 slightly hotter than what the expectations were at the moment. Let's kind of quickly check in with the panel.
Leisman, also Betsy Stevenson, who is professor of public policy economics at the University of Michigan, and Joe Lavorgna, who is SMBC Nikko Securities America chief economist. Steve, we're going to go to you first for a little more context on those numbers that we're looking at. Up 0.3%, which is in line with expectations, but Rick pointed out some of these things that are very concerning.
Well, first of all, some things I think that might concern the Fed is that we're still not getting the sheltered disinflation we thought we might get. I think that's going to be a bit of talk about that today. 0.4 on the shelter after 0.3. I don't have the owner's equivalent rent right in front of me. That's another table I can call up in a little bit. But food at home is down. Talk about people are concerned. There's been some, I've noticed this, that in the circulars you get, there's a little more price competition, perhaps at the grocery store. That's up. Food at home, just 0.1% overall. Food, 0.2. And as Rick pointed out, gasoline flattering this index down 6% on the month, down 8.9% year over year. And then a big surprise here is an increase in used car prices, up 1.6. There was general belief this was going to fall. It did not fall. It was down 0.8 in the prior month. The reporting by Phil LeBeau had suggested it might fall because of his reporting from the auctions. Another interesting thing is we talked about all this holiday spending that's been out there. 2 points. One is that apparel is down 1.3%, but also real earnings, inflation-adjusted earnings up 0.5% after being negative. So as you'll note, the CNBC NRF retail monitor noted a healthy gain in November, as did the Bank of America data you had on earlier this show. All of that powered by consumers, and consumers being helped by inflation rising less than in this past month. Their wages rose. Becky?
Okay, Steve, let's talk a little bit more about this with Joe Lavorgna. Joe, obviously this has huge implications for what the Fed may be looking at. What would you take away from this?
Stephen made some very good points about what the Fed will look at. But, you know, the thing is, on the energy side, Becky, I think what's really important, energy now is down over 5% year on year. And as energy moderates, you're going to see all those secondary and tertiary effects, which bled into the rest of the CPI, those will come out. Transportation, obviously, is a huge cost. And, of course, there's petroleum's in a lot of different products. So as energy moves lower, you are going to see your core rate drift down. And I think the trend is certainly lower. With housing, we're going to have a record amount of multifamily units built this year. And that really bodes well for much lower rental prices going forward. We are seeing the rental vacancy rate rise. These data will keep the Fed from being too dovish, but we're still on course for Fed easing, and we're still on course for much lower inflation.
Fed easing when?
I think next year, and I still would not rule out March. I know the market now is under 50-50 on a March cut. But if we get some weak data, we've got 3 employment reports between now and then, a March cut very much comes into focus. And that would actually be consistent with history when the Fed basically waits about 8 months from its last hike to its first ease.
Betsy, are you in line?
But see, the thing is that, okay, there was a point there that he made talking about the first cut being in March on the back of lower or weakening unemployment numbers. And one of the things that I asked you guys before I actually went live, I was asking everybody was, what do you think the Fed's main objective right now is? Is it to bring inflation down, or is it to fight the recession and improve unemployment if and when we actually see the weakness in the labor market? Let me know in the comments in the live chat, what do you think the Federal Reserve is going to be more focused on? Is it to bring inflation down, or is it to actually fight a recession if we get one? Okay? Because for me, I think the Federal Reserve is going to be more focused on bringing inflation down. Now that obviously is going to happen even if there is a recession, if unemployment starts to go higher. the Federal Reserve is banking on the idea that if and when unemployment starts going up, they're hoping and they're banking on the idea that inflation is going to be back down by then, so that then they can start cutting interest rates so that they can now control and support the economy. If both of them happen simultaneously, where unemployment starts going up and inflation also stays up, that's a big problem. That's probably the worst problem on our hands that could potentially happen in 2024, because core, it's really core that's not moving down as aggressively. It's moderated a little bit. So the last 3 prints, we've only gone from 4.1 to 4%. We've just been kind of stable at these levels, and we're kind of moderating and rounding out at 4.14%. And even though energy was down, that doesn't help core because core doesn't include for energy. And energy was down, 5.8, 6%, 2.7% month over month. And it's in full swing deflation at the moment. What's really going to affect, what is the one thing that's going to affect core inflation moving forward? What is the one thing that needs to come down significantly that's going to help core inflation? You should all know the answer to this question. What is the one thing that needs to come down that's going to help core inflation come down dramatically, which we have not yet seen? We have not yet seen. In the real world, sure, there might be the rate of increase that might be starting to go down, but we haven't seen prices for this particular item go down. What is that one thing? What is the one thing that's going to help core inflation come down? I want to hear from all of you, all the people in the live chat. I want you to answer this question. Yes, so David says shelter, right? So pretty obvious. It's shelter. It's shelter, it's housing. Shelter makes up over a third of inflation, and more specifically, core inflation has got even a more bigger weight, and it's still up 0.4%. Rent, housing, rent, shelter, you guys are all right. That's what's really going to drive core inflation lower. And if you don't see that, then core inflation will continue to moderate, right? It's not really going down, it's going sideways. And this is still 2 times more than the Federal Reserve's target. And now let's just jump over to the Fed Watch tool. Let's see if this thing has changed, but I want to hear from all of you as well. Earlier, the market was pricing in 5 cuts in May, starting May all the way through December. What do you think the market is pricing in now after the inflation report that we just got? By the way, QQQ's kind of sold off a little bit. SPY also sold off a little bit. It's now mostly flat. The yields slightly pushed higher, back over 4.2%. And we've got the dollar index, which is also spiking back higher. So we can see the last 15 minutes, the dollar index did jump about 0.17. But yeah, what do you think is going to be the change in the Fed funds futures for interest rate expectations going into 2024? I'm gonna scroll down. I'm gonna release these. We're gonna go over these, but I want to hear first what you think is going to be the change. The same 5 cuts. Retromancer says no change. Okay, no change. Still 5 cuts for the next year. So let's just quickly run through. And okay, so right now still 5 cuts. By the way, this will take some time to adjust. It's only been 10 minutes since the numbers have come out. So 1, 2, 3, 4, 5. Still 5 cuts priced in starting in May of 2024. But we will come back to this in 15, maybe 20 more minutes, because it does take time for the Fed funds futures to adjust to the new information that just came out about 10 minutes ago. So yeah, overall, I would say inflation numbers were good. Month over month headline did increase, but I think that's more of a rounding error because people were expecting no change. We were up like 0.01%. But the main key statement, which I think is quite interesting, is that is core inflation price index, which is at an all-time high, I think that's what everyone needs to understand, is that inflation is still persistently high. In other words, prices are still going up because core inflation is up, and the index is at an all-time high. We've never seen the index at these levels, but it's just the rate of increase that is now going down. And wages have clearly not kept up. Wages have certainly not kept up to the increase in prices. And more specifically, if you take a look, where did majority of inflation really take place, right? Really take place. I mean, I don't have the ability to kind of overlay the Fed funds futures on this, but if you take a look at where the actual price index was, this is the CPI price index, we were incredibly flat since 1915 all the way through 1965. So for 50 years, right? Yeah, that's 50 years. 50 years in between this time period, inflation, in other words, CPI was flat. It was sideways, 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 and then look what happened in 1970s. 1970s all the way through where we are now in 2023. This has been absolutely astronomical increase in overall CPI, in overall inflation. And wages have certainly not increased all that much. If you zoom in, you take a look, this was more linear. This is more parabolic. You can see this right here. It is a lot more parabolic. It's a lot more violent, a lot more aggressive than what we have seen in the past. Same thing that happened over here in 1970s and 1980s, right? We're kind of going up in a linear fashion. It's more parabolic over here. All because of course, interest rates getting cut dramatically. And that's causing, recession, interest rates getting cut, and then causing prices to go up significantly. And the Federal Reserve raises interest rates to bring inflation back down, and that cycle repeats itself. But I think this time around, Jerome Powell and the Federal Reserve kind of understand the implications of lowering interest rates too much, too fast, even in a recession. So I think they maybe, if they've learned their lessons from the past, they will let the economy work itself out without that intervention from the Fed of lowering interest rates to stimulate the economy and kind of help support growth in labor market. Because every time they do that, they basically risk reaccelerating inflation back higher, right? That's happened twice, actually three times in 1970s and 1980s. Not once, not twice, not three times in Paul Volcker time, where they cut interest rates, inflation goes back up, they raise interest rates, economy's in recession, they lower interest rates, inflation goes back up again. It's like, God, it's not that difficult. Like, they just make it super complicated. So shelter one come down for sure. Stocks and AI says, Tushar says 5 cuts. Yep, so that's what the market's pricing in right now. But we'll reload this right now because I think it does take a few minutes to kind of readjust to the new expectations. Maybe the market's still pricing in 5 rate cuts, but I think it's the core inflation, which tends to be a little bit more stickier out there. Peter says, yeah, we know it's getting expensive out here. And that's the whole idea, right? 2, 3, 4, 5. So still 5 rate cuts is what the market's pricing in right now. Look at the dollar index, almost positive now. Definitely seen a pretty significant move to the upside with the S&P now basically flat, and the Nasdaq here also rolling over with a lot of individual stocks like AMD pulling back 1.3. We've got Nvidia slightly down about 30 basis points. Tesla, on the other hand, is down about 0.5%, and Apple down about 33 basis points at the moment as well. Kevin says stagflation. Yeah, stagflation is also probably one of the most likely scenarios going into next year as well. And that's also what Ray Dalio's mentioned for overall inflation and overall economy going into next year. So again, if you have any questions about specific stocks or macroeconomics or interest rate or inflation, happy to go over those. I think somebody asked about the TLT and TMF trades. So M Pharma, what is your prediction for TLT? The yields are still kind of dealing with 1 demand and 2 supply forces right now. Actually, 1 supply and 2 demand forces right now. We did see a pretty big technical breakdown. There was a negative divergence. I'm no longer in TMF at the moment because it was getting way too overbought. And I'm planning on re-entering very soon on this trade again, but just considering how overbought we really are and the fact that the yields could see a little bit of a bounce back higher from these levels is one of the reasons why I'm not planning on buying at the moment. But yes, eventually I do plan on re-entering this trade once again. So really the focus is going to be on the 10-year yields, the 20-year yields. We're seeing a little bit of a bounce back higher, and if you do cross back above 4.2.5%, 4.3, 4.4, then it's possible that TLT TMF starts to pull back, and then I'll be looking at re-entering that trade once again. It was a macro tactical play for me from the beginning of this year, which turned out really well, so happy with that. And then of course next year we'll be looking at re-entering that trade again. But we also broke down a report from Jim Grant, who talked about that interest rates are going to be higher for much longer. And he also talked about how there is a 40-year bull market and a 40-year bear market for interest rates for the bond market, as we have witnessed in the last 80 years. So what he's expecting now is for the yields to stay higher for longer, and for the bond market to continue to trend down. And it's a beginning of a new regime in interest rates. So Dixon, so do you hold TMF overnight or is it for day trading? So it was a swing trade for me. So I did not day trade it. It was a swing trade over several weeks and even months. I ended up building my position at around 475, which pre-split was 475, post-split 47.50, and exited around $60 for TMF. And we'll be looking at, once again, rebuilding that position again. If it ends up dropping back down on the back of yields, kind of seeing a technical rebound, considering how much they've pulled back. One sector, one part of the market where I am planning to buy going into next year. Anyone want to take a guess? What is the one place? Yes, Frank, I'll come back to SWAV in just a minute. But one sector, one part of the market where I am planning to allocate more. Anybody wants to take a guess? I feel like it's got lots of opportunity. There's dislocations in that particular area. It's underperformed relative to the S&P, the NASDAQ. And it's underperformed because the yields have been higher. So that's one place where I will be buying more of and allocating more. Biotech is one. Absolutely, biotech is one. Gold is another, but it's not going to be a pretty significant position in terms of allocation. Energy is, well, renewable energy is one of the one, but it's small cap. It's IWM. It's small cap. I feel like IWM small cap has potential going into next year because technology has been a little bit more of a crowded trade for this year. And if you remember, going back last year, December of 2022, I have to find that video, but we talked about how energy is not going to be performing well in 2023. Energy is not going to be the trade for 2023. It's going to be tech. We talked about this. And this year, going into next year, I'm not for making predictions. As you guys know, I don't like to make predictions, but I'm going to be somewhat scaling up on IWM and more on the smaller cap, mid cap space because they haven't really done anything. They've been underperforming on the back of higher yields. And if the yields do end up pulling back, as we expect them to, with the market's pricing in 5 cuts, not to mention if there is a recession, inflation's back down, there's a probability for more downside on the yields, then IWM and small caps have the opportunity, the potential to do really well. Are we still doing SoFi buys for correct answers? Yes, we are. We'll be buying more SoFi slowly and steadily. Okay, let's take a look at SWAV for Frank here. Shockwave Medical. Frank does come out with some pretty good stocks in terms of the companies that he does find. So let's see, 708,000 shares traded daily, 6.2 billion market cap. Recently turned profitable in 2022, but it definitely does feel like a pretty outsized gain. So I'm assuming there was a lot of intangibles or maybe something that was like a one-time gain for the company. I'll have to look into that more. It definitely was because it does say fourth quarter 22 was 98% profit. But let's take a look at the overall technicals. I would be watching a very strong support for this company at around $127. So this right here would be that level, and resistance all the way up here at $315 per share. So right now, of course, a lot of consolidation. Maybe there's another support sitting right here at around $168, $160 per share for Shockwave Medical. And let's just quickly run through some of the expectations. Earnings are expected to increase to over $7. Revenue also expected to go up to over $1.3 billion. And statistics-wise, I would say reasonable valuation, 38 times earnings, 27 times earnings, 37 times cash flow, almost 10 times sales. And we've got a quick ratio that's very strong. So balance sheet definitely does seem to be pretty good for the company with a negative net debt and a very strong current and quick ratio. So this is the range within which it's been trading. Definitely does make for a pretty decent swing trading opportunity, Frank. I would say at $160 with a potential back up to 220 to as much as 234, and of course all-time target at $315. So Walt, what is the thesis behind small caps investments in 2024? So I honestly think that small caps, number one, are undervalued relative to the actual, so in other words, the price to earnings, price to sales, the multiples have compressed because of the underperformance and the higher yields. Number two, I'm not looking at specific like small cap companies within IWM, although there might be some, like Supermicro Computer, for example, is part of IWM. It's actually one of the biggest holdings in IWM, and Supermicro has done really well this year for an AI boom. But I feel like if yields do end up coming down and there is dislocation with lower valuations, then there is possibility that that sector performs really well going in next year, considering that technology has been very overcrowded, especially when you consider big tech, large cap, Magnificent Seven companies. It's been very overcrowded this year. It's now starting to get overcrowded. So those are some of the reasons, and I'll be doing a more specific video on IWM as well. And let's see, the peg of 0.16 is what did it for me. Yes, it's got a really low peg. I was looking at the earnings expectations, very strong earnings growth relative to the price to earnings multiple. A peg ratio of 0.16 definitely is quite attractive for sure. Yeah, so renewable energy. So there's 6 areas in the market that we have already identified that I think are going to do really well, considering that yields are on their way down. But it's just a matter of can they continue to go down or not, right? If they continue to go down, then that's great. If they don't, then of course that's going to be a bit of a challenging environment for a lot of these companies, especially when you consider some of the more zombie companies as well that have a lot of debt, a lot of floating rate debt, and don't have the best balance sheets or the income to kind of keep up with the interest expenses on the back of higher interest rates. Burlington and Samsara, interesting companies, so we'll take a look at that very quickly. So Burlington Stores, BURL, very nice move to the upside coming in. So massive support, I would like to mark out at 110. So very strong support there. And let's see, we've got $4.2 billion of net debt, so a little bit more debt than cash. Valuation's a little bit on the higher side at 38 times earnings and cash flow at 13 times. Price to sales at 1.2. Earnings expectations are also pretty strong. I would say expected to reaccelerate back higher from $4 to over $10. It's over a 100%, 120% increase in the next 4 years. And revenue is also expected to go up from 9.6 billion to over 12, almost $13 billion as well. So I'll add it to the watch list. And stocks that I want to analyze in the future, 242 is going to be that next resistance to watch. I've done a video on Samsara in the past, so we'll definitely maybe do like an updated analysis on that company. Tuda says gambling, DraftKings. So thing with gambling stocks, again, and DraftKings more specifically, there's a lot of regulatory oversight, so that's the risk. But at the same time, the moment the company becomes profitable and is able to generate GAAP earnings is the moment that I would be a lot more interested in this stock. But in the meantime, of course, you got to be very careful, maybe a smaller allocation, because a lot of the companies that are not profitable, they're very, very risky, right? Because you don't know what the long-term execution plan is. That's one of the reasons why NEO's underperformed. That's one of the reasons why Upstart's struggling now. DraftKings, for the most part, was doing really poorly. It was down 85% at one point. Of course, it's rallied back up very nicely, but profitability is very, very important for any business. If you are going to build a long-term significant position in that stock, you better do it, in my opinion, in a company that's generating very strong cash flows, has good earnings, good balance sheets. Like, these are important criteria for quality companies, okay? If you are looking at a company that may not be profitable, may not have positive cash flows, may not have the best balance sheet, you can always start small, right? You can always start with, let's say, less than 0.5%, less than 1% allocation, and then you can eventually size up as your confidence in that company grows. It's a very slow and steady process of building these positions. Even with TMF, I didn't really go all in. With Tesla or Meta or any of these companies, I'm not going all in at once. It's a slow and steady process of kind of getting familiar with them, getting familiar with the price action, getting familiar with the thesis, with the fundamentals, the technicals. There's a lot of layers that go into it, right? So it's a slow and steady process of investing over time as you build that conviction, you build that confidence in that particular company or stock. Because at the end of the day, and that's another thing, right? That's one of the things that I mentioned, is that until you build your own conviction in a company, you're not going to have the stomach to hold it, right? So if somebody tomorrow, like you go to a family event or a family party, and your friend or your uncle or whatever comes up to you and like, oh, this is a stock that has potential, and next day you go ahead and buy it, right? When times get tough, what's really going to help you hold on to that stock? It's your conviction. And your conviction can only be developed once you learn about the business, you learn about what they do, you learn about what their fundamentals are like, you learn about what their growth is like. That's the only thing that's going to help you hold through the tough times. If you don't know anything about the company, stock nosedives 20%, what are you doing? You're going to panic sell. I've been there before, I've done it many times. And the more I know about the company, the more I'm convinced that it's going to be a good position to hold on to for the long term. The better it is. The less I'm going to panic sell. There's another small cap that I'm looking at. I'm not, as of yet, looks very compelling. Love to hear your thoughts on SHLS, Shoals Technologies. I'm definitely going to be adding some of these companies to the watch list for further, more detailed analysis. Kevin says, paper hands, baby. 2.3 billion market cap. Kevin, we got to step up our meme game, man. Like, I wanna laugh. I want to see some more memes. We got to step up our meme game in the Discord. All right, so BYND Ball, we'll take a look at that company as well. I believe Warren Buffett is all out of BYND. Will there be a correction beginning of next year? So don't know about like a correction meaning over 10%, but a pullback, yes. I believe there is going to be one considering how technically overbought we are, and this is a normal thing. It's not something that should make you like afraid or something that's gonna get you in the state of panic, but it's a very normal occurrence for the markets to pull back after having 7 weeks of strong green rallies. And the fact that we've moved higher so much, it is very normal for the markets to see a bit of a pullback or a dip. Because when we do the analysis with respect to where we are, by the way, this is going to be available for everyone. So if you want to access all of this, link's going to be down below for all of our Excel spreadsheets. So you will be able to access like our watch list, fair values for individual stocks, the fundamental analysis, spreadsheets, volatility spreadsheets, retirement calculators. You can download and play along with those. Of course, tutorials and private videos, everything's going to be available with the Discord access and over 20 plus channels, including trade alerts, find out exactly what I'm buying and selling on a day-to-day basis. But the reason why this is so important, data-driven analysis, because it gives you a good idea, a good logical reasoning as to where the markets are in the current environment, right? So if you take a look at the RSI right now, 69.29 for the market. This is going back almost 100 years. We're normal right now. Last week we were at a rare territory. And if you take a look at the daily moves, the markets did see a very small pullback, right? We didn't really, actually, it's not even a pullback. It was mostly consolidation sideways for a very long time, for several days, 2 weeks, 3 weeks of sideways consolidation, then again, re-accelerating back up. And now the RSI is back over 71. So the number of times the RSI is over 70 in the last 100 years is only 2,349 observations. That's 10.27%. It's a really, really low probability for the markets to be overbought as much as they are. Same thing is true with the volatility. Same thing is true with NASDAQ percentage of stocks, S&P percentage of stocks trading below their moving averages. So it's not a prediction, but it's an assessment of the current environment. And that assessment leads me to believe that this is not the time for me to be long on any trades, especially not on the market. So like, for example, QQQs or S&P or the Dow or even SMH or any of these trading opportunities, the long side is quite unfavorable. But once we see that pullback, once we see these numbers kind of normalize a little bit, then guess what? It's going to be back to buying, dollar cost averaging. That's exactly what we were doing back in October, right? So October 2023, earlier this year, literally there was buying opportunities, time to deploy cash, down over 20% back in a bear market. Volatility was high. It was in fact elevated up to as much as 23, 24. So we were right there inside this green rectangle. And it's just this constant analysis of the present environment, of the current situation that we're in. And we can, and the thing is that we can be overbought longer than we can be oversold. That's the way the market works. We can be overvalued longer than we can be undervalued in the market, because if you look at the last 100 years, what have the markets done? They've gone up. They've gone up, right? They've consistently gone up. So it's a fact the markets have been overbought more than they've been oversold. So volatility can stay down there and market can stay up there for longer than the opposite is true, right? Because volatility is not going to stay up there for long. It's going to go up to 70, 80 in an environment of fear. It's going to give us a very small window of buying opportunities, and then boom, crash down, and market's going to start rallying back higher. But on the other hand, market's going to continue to drift higher and higher, stay overbought, and volatility can stay low for longer. So hopefully that makes sense. What are your top 5 holdings and what percent cash you are right now? So I think I'm a little bit over 20% cash, and top 5 holdings again includes Tesla, VUG, we've got SMH, we've got Realty Income Corp, we've got, I'll have to do like a portfolio update for all the members. I will be doing that very soon, and that's going to be one of the members only private videos with everything. But yeah, it's Tesla's still the biggest holding. I did trim Meta. But of course, there's going to be other companies that are also included. Costco, can you cover Costco? So King, Mas, brother, I did actually do a video on Costco a couple days ago. I did a complete video on Costco. Definitely do check that out. I did an analysis on the entire company. But yes, it is incredibly overbought right now with the RSI at over 76 and MACD very, very overextended. But as we discussed earlier, the markets can remain irrational longer than. Finish this statement in the chat. The markets can remain irrational longer than you can blank. Finish this in the live chat. But that's what happens, right? I mean, we know that the conditions are overbought. Conditions are not great for the long side of trades for us to go higher, but the markets can keep going higher. But it's just about that marginal upside versus marginal downside, which is not great. Well, Caddy, great to be a good member. Looking forward to this holdings update video. Yes, thank you so much. Appreciate that. Longer than you can remain solvent. Exactly, right? So we have to understand that, and it's a constant assessment of risk reward. I have no problem dollar cost averaging into some of the broader based diversified ETFs and index funds. I will still keep doing that regardless of where the prices are, valuations are, and technicals are. But when it comes to trading opportunities, our core focus is on risk and reward. I will always keep saying that. Kevin says, I can stay sane. Yes, so SHLS, let's just go back to this company. So I think we already identified some technicals. I would say support level is going to be down here at around 963. But if you take a look at the company fundamentals here, looks like a very nice, strong year in 2022. 16 times earnings, 22 times cash flow. But I'm not really sure if that earnings multiple is correct, Frank. I'll have to look into it more because you can see the fourth quarter 22, it's got more profit than actual revenue. So I'm assuming it was either a gain, one-time gain, or something they realized on a one-time basis. And the last 3 quarters have not been super great in terms of profitability. I mean, they've been profitable, but third quarter 23 was again generating a net loss. So I'll have to look into this company in a little bit more detail. Does have more debt than cash on the balance sheet right now. Positive free cash flow, so that is good to some extent. And earnings expectations are pretty strong for this company. So we'll take a look at that company here in more detail. Oracle, I did a video on Oracle as well, down almost 9% on the day today so far. So beat on EPS, miss on revenue. I think the price earnings multiple, though, the valuation for this stock relative to the earnings growth is a little bit too much in a sense that, in my opinion, it doesn't deserve that high of a valuation multiple. So for that reason, I'm not really interested in Oracle right now. However, I think I did put down a fair value of closer to $90. Now, what is interesting about Oracle is that they've got a lot of debt. Like for a software company, for a packaged software company with high margins, they've got a lot of debt on the balance sheet, which is actually quite surprising. I'm just going to drink some water here. Hold on one second. They have a lot of debt. And that's exactly what we analyzed in that video, was that how is it possible for this package I think it might be acquisitions. The company's done a lot of acquisitions over the years, and that could be one of the reasons why we do see Oracle with over $80 billion worth of debt and little to no cash. But But yeah, I mean, for me, sub $60, even though I think might have put down the fair value closer to $90, I'm still not super convinced. I think I put down over 20% margin of safety for Oracle. MP3 says chug. You know, I recently learned, Matt, that there's a thing related to drinking water as well. I always thought that if there's one thing that can never get you sick, like we say that, okay, everything should be consumed in moderation. And I was like, okay, if there's one thing that you can actually go over and above on is water. But then I learned that even water, if drinking too much water too fast, can create a problem. I forgot what it's called, but I was actually surprised to learn that. I was like, wait a minute, that's crazy. If you drink too much water too fast, it can create something. I forgot what the name was, but I'm sure you know, but I was kind of shocked. I was like, wow, even water should be consumed in moderation, specific quantities, and you just can't have too much too fast. But anyway, for Oracle, sub $60 is really what I'm watching at the moment. Kevin says too much water can kill you. Yes, it's called hyponatremia, something like that. I remember something like with H that it's called. But yeah, that's the only thing I usually drink along with coffee every morning, of course. But anyway, so QQQs right now basically flat. So after the inflation numbers, 12, 13 basis points higher. We got the S&P 500 also very, very flat. The government yields, the 10-year yield more specifically, down over 35 basis points. Lead down here, Sacramento doing a water chugging contest for cash. Wow, that's crazy. That's wild. Scary stuff, huh? It's life's a one big experiment, I feel like. You're just learning as you go. So Frank, my highest conviction play for next year is URI. Okay, let's do this. To make this a little bit more engaging and more useful for each and every one of you, let's do this. I'm going to create a new list, okay? And I'm going to call this, so I'm going to create a new watch list. And I'm going to call this highest conviction, okay? I'm going to put down my highest conviction stock for next year. This is based on my thesis of the interest rates and if and when they actually do get cut. I believe Enphase is actually going to be one of the best performing stocks for next year, in my opinion. We'll find out. But I want each and every one of you to share your highest conviction stock for 2024. As we close out this year, what is one stock that has your full attention and your highest conviction play going into next year? You're spending hours learning about that company and you believe that this is it. This is going to be the one that performs really well going into next year. The thesis could be your fundamental analysis, macroeconomics, interest rates, economy, the Fed, whatever. But what is your highest conviction stock going into 2024? So that we create this list and we can kind of look into those stocks as well. So, and it's useful for everyone else to kind of share ideas and of course look up other stocks that may not be on your list. So we're gonna add UNP. We got Biogen on the list. Okay, so and now we're gonna add, let's say AMD. AMD is a very good one. I like AMD. Fortinet. Let's see, FTNT. We got XBI, so yep, small cap biotech, no doubt about it. TSLA, Tesla, of course. We got TSL. Okay, so that's going to be this one. DNA. Oof, you guys have got really interesting ones. We got PayPal in the mix. We got NVIDIA. We got Chewy. Wow. SQQQs. Wow, okay. Somebody's bearish going into 2024. Chipotle. CRISPR Therapeutics. We got Okta. Ooh, Iqbal's got a lot of them. SoFi, Palantir, AMD, PayPal, and BYND. Tesla dependent on interest rates, so could benefit. I agree. Enphase is the same way. SMCI, I feel like, has already done really well this year. It's up over 250%. So we'll see if it actually ends up doing well next year. Amazon, SSNT, Verizon, volatility. Love it. PayPal, Enphase, AMD, hopefully Baba as well from Stefan. Unity Software, Enphase we already added. Okay, so far we've got a list. We've got a good list. These are all stocks that folks are most bullish on or have the highest conviction going into next year. I'm sure there'll be more on this list, but it's just a good practice for everyone to kind of look at other companies, right? Because if it's coming as a highest conviction stock, that definitely holds a lot of weight. So this kind of serves as a list of other people's highest conviction companies that we can analyze and of course do more research on and see how it fits with our analysis. Celsius, we got Neo, we got Airbnb. Palantir is already up there. Zscaler is a good one. ASTS, I'm not sure what that company is, but we'll add it. STNE, StoneCo, we got NU, and we got SoFi already up there. VMD. Wow, that's there's quite a few that I might be interested in looking into. URI, VMD, SSNT. So there's quite a few that I will be doing more research on. And that's why this practice is so helpful, because it kind of helps us understand other stocks. So Airbnb is already part of the list there. Airbnb, very, very bullish. I like the experience aspect of Airbnb, something that kind of makes me more bullish as well, because every time I've been on an Airbnb experience, I've had the best experience. I've never had any problems in any sense, because especially for solo travelers, I think it's one of the best things that they can do is go on these experiences when they visit that place. And I think it's still very underrated. And the fact that Airbnb is being added to the S&P 500 definitely makes it quite a compelling case, makes a compelling case for wow, or how it could be one of the best performing stocks going into next year. Again, we'll find out. Technoglass is another one, but with Technoglass, it's kind of indirectly, once again, correlated to interest rates. If interest rates are higher, there's going to be less infrastructure projects. If there's less projects in construction and infrastructure, less demand for glass, right? So a lot of the ones that we're looking at, for example, InMode, Technoglass, Enphase, Tesla, Palantir, a lot of them are dependent on interest rates. Viva Systems is a phenomenal business. Marathon's had an insane year so far on the back of crypto. Absolutely incredible. Etsy, JP Morgan, IWM, we definitely got to add that one. It's the mix. All right, so this list I will share with all the members in the Discord for people to do more research on. If there's any companies that were not originally on your list, you can add them on your watch list to do more research, see how it fits with your analysis, with your thesis, and then of course you can make a decision that way. But yeah, these are the highest conviction stocks among our community right now on YouTube. So I'll share this list with everyone. QQQs right now still pretty flat. So is the S&P, very, very flat. Markets opened about 14 minutes. The dollar index starting to come back down, with the government bond, the 10-year yield, slightly down about 45, 46 basis points at the moment as well. The Chipotle wannabe, Kava. Never been to Kava, but I've heard it's actually pretty good, quite comparable to Chipotle. I think 2024 could also be another IPO year where a lot of companies could once again start going public again. It's just the private valuation has been crushed for a lot of these companies, considering how high rates have been. Boba, bro, no one talks about my hood. What's up? So Robinhood, wow, phenomenal move to the upside, back up to almost 1279, huh? It's gone from like 785, 50% rally. 1279 is going to be that next resistance I'd be watching. Little bit of that symmetrical triangle, got a very strong breakout. Resistance at 1289, then of course sold right back down to 781. Massive move to the upside, of course, overbought now with RSI and MACD, so be careful at 1279 resistance for this company. Mark says, did the leap within mode? InMode's actually, again, a phenomenal company in my opinion. It's just, it's been troubled by lower demand, and there's an element of risk with InMode because of the fact that their revenue resets to zero every year and there's no element of that recurring revenue or subscription model or software, it's all hardware, it's all capital equipment that they need to sell each year. So that's the only risk that they carry, but the balance sheet is phenomenal for InMode. So $21, my fair value is just a little bit under $20, closer to $19. So SYM, we'll add that for Frank, says it's probably one of the most underappreciated AI play. We'll do an analysis on this company as well. Frank, walk us through your process of screening for stocks. I'm curious. But yeah, this one 315% gain so far on a year-to-date basis. Novo Nordisk will definitely be added. Satya, that's another great stock. I think out of Denmark, we've done several analyses on this company, several videos on this business. Valuation's a little bit up there, but man, oh man, what incredible fundamentals, high quality company that this one is. So very, very strong move to the upside for Novo Nordisk. So Genesis Enphase also without recurring revenue. Not quite. They do have recurring revenue aspect with their services and the application that they provide. But the difference between InMode and Enphase, I would argue, is that Enphase has got a much, much larger total addressable market versus InMode, which is mostly into cosmetic surgery. So cosmetic surgery market obviously is not as big as the renewable energy space with solar panels and solar inverters, battery packs, solar systems, all those things. And of course, with the transition towards renewable energy, with the push from a lot of governments around the world, subsidizing and encouraging people and businesses to adopt to their renewable energy is much bigger TAM versus InMode. But even Enphase does have that recurring revenue. Of course, it's a very small percentage of the overall revenue, but it still has that component in there. 10-year note going to the moon, so US 10Y. By the way, we do have auctions later this week. Let's just reload, see where the inflation interest rate expectations are now, and if we have moved or not. So, okay, 1, 2, 3, 4, 5. So market's still pricing in 5 rate cuts for next year. Inflation's already out. And tomorrow we've got the press conference from the Federal Reserve, FOMC, 2:30 p.m. Eastern. I will be live to cover the press conference and the summary of economic projections as well. So all that is going to be released. It's going to be a pretty late live stream. It's going to be at closer to 1 a.m. Or no. Yes. 1 in the morning. Yeah. That's when the actual Federal Reserve, Jerome Powell, starts talking. So Alibaba, I'll be doing a video on Chinese stocks. I think there's an update that's due for a lot of Chinese companies here. We'll be doing that very soon. But of course, continues to sell off, breaking down below $70 per share. And the next support really is going to be $58 per share for Alibaba. So that's going to be that next support, unfortunately, for the company. And it's been under a lot of pressure. Anyone want to take a guess on which company in China is planning on going public in 2024, and it is going to perhaps be the biggest IPO that a Chinese company is going to have in the US? Let's see if anyone can guess this. Which Chinese company is planning on doing an IPO in 2024 in the United States, which could probably be one of the, if not the biggest IPO of a Chinese company being listed in the US? After Didi. Which company are we talking about it? Anyone want to take any guesses? Ooh, Frank. Already on top of this. Shane. I'm not really sure how you pronounce it, but that's the company, yes. Man, on top of it, yes. That's the company. I've got a video coming out later today on them. It's a fashion brand clothing company. And yes, Temu is another one. Temu, but it has a holding company through somebody else. But yes, Shine, that's how you say it. I'm assuming that's how you say it. Clothing brand, fashion brand, worth almost $100 billion in the private markets. And they're planning on going public next year. So we'll be doing an analysis on them. Got a video coming out later today for them. Yeah, Temu is another one. Temu, but I think is owned by another conglomerate, another like company that owns. Yeah, Pinduoduo, that's the one. Pinduoduo, PDD owns Temu, which is going to spin that company off and do its separate IPO. Yeah. Clarification companies. Sheen, Thomas says. Sheen, okay. That makes more sense. Sheen. Okay. So with respect to the yields, the short end of the curve continues to be a little bit more elevated at over 5.4%, and the spreads are still negative. Walt says Sheen is an awful company. They will at some point get lawsuits because they steal all the designs. Yeah, that's one of the concerns and threats I've highlighted in the video. There's two concerns. Number one was the idea or the conspiracy that they have stolen a lot of designs from artists and different creators. And the other one was how they import cotton to actually produce their clothing, accessories, and clothing. But at the same time, there was a report that suggested that less than 2% of cotton, less than 2% of their overall cotton imports are coming from unapproved localities. So maybe it's not as big of a risk, but yes, the design thing, the content, the IP infringement is definitely a bigger problem for Sheen. And all that is discussed in that video that I have coming out later today. What do you think about Coinbase for next year? So Russian Coinbase, very much dependent on crypto. It has done really well, but it's also incredibly overbought, coming up to that resistance at around $152. So in the short term, I'm not super confident if it's going to see more upside, considering how overbought it really is. You can see the RSI MACD starting to roll over. So support level is going to stay put down to 112. But going into 2024, it's really dependent on how crypto does, right? So Ether and Bitcoin, if they're going to be strong, if they're going to see a lot of momentum, yes, Coinbase and Mara and CleanSpark and GBTC, a lot of these could actually end up doing really well. But if Bitcoin doesn't see a lot of momentum, Coinbase is directly correlated to how Bitcoin is going to do, or how crypto is doing. All right, everyone. So that's going to be it for today. Thank you so much for joining into our live stream. Definitely do drop a like. I would really appreciate it if we can get up to almost 200 likes here on this live stream. And market's going to open in about a few minutes, but QQQs and SPY are starting to pull back a little bit. We're basically flat on the day right now, with the yields also very, very muted. Volatility is also muted, down almost 2%. Inflation numbers coming in line with expectations, with slightly hotter numbers on the headline month over month. So BYND, we'll take a look at for Iqbal very quickly, and I'll point out some levels of support and resistance. But this right here has been the overall downtrend of consistent selling pressure. Support level at 550. We got a resistance now pretty much approaching at 994, closer to $10, in line with this previous support level. And of course, resistance staying put right here at $10. And we may start our regular market open live streams every so often, because I miss doing these. I think they've been always super fun, being able to communicate, talk to you guys every day, and of course talk about the markets, economy, inflation, recession, all those things, and of course go over individual stocks so we get good ideas, engaging ideas from our community members on what stocks they have highest conviction in, of course what we can analyze together as well. So again, thank you so much for joining. Really appreciate you all. Make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below. Don't forget to sign up if you haven't already. You get access to all the members-only private videos, of course, Excel spreadsheets, Discord channels, trade alerts, everything's going to be included. So Walter, Caddy, now that Enphase is out of the NASDAQ, where will it trade? So there's a difference between an index and an exchange, okay? Enphase is not getting kicked out of the exchange. It is not getting delisted. It is only getting pushed out of the index, which is the index of 100 companies, largest non-financial companies. So there's a difference. It's not getting delisted. It's still going to be listed on the exchange and be tradable. but it's just getting pushed out of the index. So there's difference between indexes and exchanges. So hopefully that clears it up. Anyway, thank you so much for joining. Happy investing, and I'll